Working capital is like your company's oxygen tank. If you run low, you gasp for breath, but if you have too much, you're just wasting it. So, what's the sweet spot? Stick around to find out how to balance it right and learn to spot trouble before it hits. Your business's health depends on it.
Let's go to this last one. You do these educational topics, but I think this one's a really interesting one. I'm gonna let you talk about your take on it, but I have a really interesting take because I've run quite a few small businesses. I mean, like 5 to 20 million of revenue, and this topic is the one that is fundamentally the most misunderstood by small business people. Like I have on a regular basis dealt with people that are very smart, very intelligent, very successful, and they have no idea, no understanding of this topic. It's not obvious to them. It's not something that's counterintuitive, but it just doesn't necessarily click when it's not, again, it's just not obvious. So why don't you, we're talking about working capital here, folks. And my definition of working capital is the actual cash that is needed to run a business on a day-to-day basis. So you're going to see these accounting things of net income and EBITDA and all these other things, but the world actually operates in cash. I can't pay with depreciation. I can't pay with receivables. One thing that works is cash. So in all of my small businesses, we only run cash books, by the way. And this is true of many businesses. I let the accountants deal with the tax books, which are essentially the accounting books that Wall Street would use, which, is a whole nother topic, but cash is king. But go ahead. I want to hear your take on working capital and the stock.
Yeah. So just in the educational segment, I don't know that I so much have a take on it. I think we're just trying to explain it to people, but I would love to hear your stories on it. So for people who are looking at a balance sheet for the first time, the way you calculate working capital is just take your current assets, subtract your current liabilities, and that gives you the working capital, which is a decent measure of a company's short-term liquidity. Now, it does not get you the solution that Enrique is talking about, which is the important one if you're running a business. We'll get to that in a minute, but it's a good measure. And so what you want to do is get a sense of what kind of financial cushion a company has to cover their immediate expenses. And it's important to consider. So you need working capital to do things like pay your employers, pay your suppliers, pay your rent, right? And to get through any kind of slowdown in sales or an increase in costs or a seasonal slowdown, right? Some businesses are seasonal. If a company's working capital is low or negative, that can be an indicator that the business is in trouble, stretched too thin. If it's too large, right? And you think, well, wait, why would having, too much working capital be a bad thing? And the reason it can be a problem if it's too large is excessively high working capital can be an indication that a company is sitting on piles of cash or inventory. That inventory can go bad, it can go stale, it can become technologically obsolete. It's also an indication that a company doesn't have a place to put it to grow, right? It's too large working capital is in some ways an admission by a company that we don't have anything better to do with it. We don't have growth opportunities. The final thing that I'm going to add before turning it over to Enrique for his view on this is he's right that you want to be able to consider your ability to pay your bills. And so working capital doesn't always consider things like long-term assets or liabilities, or sometimes more importantly, credit lines. So you might have on the balance sheet zero working capital and think, well, wait a minute, how are you going to pay payroll this month? Maybe it's a seasonal business. And the answer might be, we have a credit line. We have access to cash. We just didn't draw it down and put it on the balance sheet because it was going to cost us something. So I don't know that there's one final answer on working capital, but as in, investors or new investors, we want you to understand it. The one final thing, sorry, I know I said final before, but that I would add to this is, my first job out of school, I was doing mergers and acquisitions at Morgan Stanley. And, we would be up all night writing these gigantic discounted cash flow models. Some of the models that I wrote actually took on the fastest computers we had like an hour and a half just to calc and print the summary pages, if that gives you a sense of the kind of size we were dealing with here. But if we had trouble from a valuation point of view, it was an old analyst trick to just cut the working capital. And that it didn't make the condition of the company any better, but it did make the discounted free cash flow calculation look better. if you hire a consultant or an investment bank, look for tricks like that where they can make the valuation seem better than it is without making the quality of the business seem better. But Enrique, what do you deal with in your
Well,
businesses?
so we'll maybe do that on another call. I'm just gonna share a hack in the interest of time. Okay.
Yeah.
I'm gonna give you one simple analysis that you should do on every company that you own, every stock. And I was short WorldCom in massive size. Okay. Over $100 million, which back then I still a big short, but and WorldCom, for those of you who don't remember, was a telecom roll up by this Mississippi school teacher named Bernie Ebbers. It was one of the biggest telecom companies in the world. It might have been the biggest telecom company in the world. And there's a guy named Jack Grubman at Solomon Brothers, and Jack was the foremost telecom guru, and he had this huge conference, and Jack's word was like he was the Dan Ives of what, but much more serious, because Jack wasn't a clown. And we were short WorldCom because we were hearing all these things about all these shenanigans. And we had one chart. It was net income for WorldCom, which was up and to the right, just every quarter, just boom, 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 boom. They were just growing net income incredibly. And then CFFO, cash flow from operations. So if you go into any SEC filing, you can pull up the Qs and the Ks, and you can see net income. It's just a number there. You can use adjusted. I don't care. CFFO is on the cash flow statement. And that's how much cash is generated from their actual operations. So the problem with WorldCom was saying that they were making like $10 billion of net income. Well, I forget the number. It was about $1 billion, whatever it was. It was a big number. And they were burning $2 billion of cash, not from investments, not from interest payments, etc.
It had to be accounts receivable.
So they were screwing with their working capital, and they were doing, to a certain extent, what OpenAI might be doing, NVIDIA and Oracle, was they were booking revenue for things that they weren't actually getting cash for. So I will just share working capital. One hack. You should run this on every company. And by the way, when you see companies that are growing net income, and sometimes some companies will have positive working capital cycles, they're growing CFFO greater than net income, that's great. That's even better, but this is one hack anyone can do. All you need to do is you pull up, and you can pull it off. There's plenty of data sources now. Just pull up those two lines, net income and CFFO, calculate the ratio and see how they're growing. And if they're growing linearly, great. If there's this pattern, I'm trying to do this here on inverse, this is net income and this is CFFO, get the hell out. Okay. So I'll say that's where, as one of I had a short book of over $1 billion for probably, close to a decade in my career. I'm one of maybe 30 people on the face of planet Earth that can say that. That was one of my first things I would do anytime I was looking at short. Just look at CFFO versus net income. So I'll leave that on a working capital hack that can potentially save you a lot of money.